What's up, everybody? Good morning, good afternoon, good evening from wherever you are. Welcome to Smart Life channel, where we discuss trading, we discuss every other thing that could help you stay consistently profitable. We don't only do trading here. So, this episode is talking about the killer breakout strategy, and gurus won't tell you this, experts won't tell you this. Reason is because it is highly profitable. They use it to profit from you when you're losing, but you don't know this. So I'm going to expose this myth to you. But before we go, just do me one favor. It might look so small to you, but please do that. Subscribe to this YouTube channel, please, and then like the video if you find it useful. Do well to share as well, and then turn on the notification bell so that you won't miss any video from me. And if you have any question, just drop it in the comment section. I'm going to answer you, or you drop it in my Telegram channel. I'm going to answer you there. Now, if you've not joined my Telegram channel, the link is going to be in the description box. Please do well to join. If you need a broker that is trustworthy and has fast execution of deposit and withdrawals, exness is there for you. Check out the link in the description. Also, I'll be dropping it there. Thank you very much, and let's dive in deep. So we're going to be talking about the killer breakout strategy. The breakout strategy, this strategy is very explosive, very profitable. You can earn so much, and it has most of the times a tight stop loss, a very tight stop loss. So retail traders are going to be liking this, but in fact, any trader you're going to be liking this. Whether you're a day trader, a swing trader, it works on all time frames. Even if you're a scalper, it also works. Even in the 1 minute time frame, it works. So let's dive in deep without further ado. What is this breakout strategy? What is it? What is it looking like? Now, looking at this chart, you can see a trend line. Good. That's what we want to see. We want to see, first of all, 3 touches on a trend line before considering breakouts. Now we have 1 here, 2 here, and then 3 here. 3 touches already. So we can now consider having a breakout strategy. So finally, the market breaks out here. The market breaks here. It breaks out here and then does a retest. That is what we want to see. We want to see a retest. But now you might be thinking, okay, just break and retest. Well, you can call it break and retest, but I'm going to show you what makes this different from break and retest as it is normally called. I'll show you. This one doesn't need candlestick patterns, doesn't need all those things. So let's dive in deep. I've told you what it's looking like. You look to enter here and then to grab this whole profit. And then why does it work? Why does it work? You might want to know why it works. Yes, a lot of people have been taught to trade whenever they see the market respecting a trend line. They've been taught to buy. For instance, in this case, an upward trend line in an uptrend, they've been taught to buy at trend line at the 3rd touch. That means here they are going to buy, right? And then price comes here again, they want to buy again. So these doji candles you're seeing, or call them indecision candles, showing that there is a tug of war between buyers and sellers. So who's going to win? Eventually the sellers won and broke through. So now they are in loss. Maybe their stop loss has been hit, or maybe they didn't set stop loss and they are just in the red. What is now happening? The market is retracing back, and when they see this retracement, what is it to them? It is to them, to a reasonable person, okay, this trend line has been broken, and it has been broken so abnormally that if it begins to go, I don't see any signs of it going back up like this. So what do? I close my trade in break even. So that is what fuels this move. What fuels this move is people's stop loss being hit. People's stop loss being hit is a fuel to move the market in the direction it wanted to move. For example, people were buying, but the market wanted to sell. That means their buy trades hitting stop loss is a fuel for this move. You get? So that is it. That is why this strategy works, because their stop loss is acting as a fuel for this downward move in this scenario. So vice versa for downtrend. So now we are going to be talking about entries, stop loss placement, take profit target, risk management, and some chart patterns that obey the breakout strategy to the best of my knowledge. Let's go. So entries. First of all, how do you enter on this strategy? How do you enter? Once you see this breakout occur, first thing you should be waiting for. Now, for a breakout to be valid for me using this strategy, although breakouts happen, trendline breaks happen all the time, but for me to pinpoint this kind of breakout strategy, what do? I want to see impulsive candles. Now, initially this was an uptrend respecting trend line, but now I'm seeing impulsive candles, and an impulsive candle that broke the trend line. So this is ministering to me. Oh my god, pardon my choice of words. So this is telling me that yes, sellers are now in control. Although the trend was previously uptrend, sellers are now in control. So what should I be doing at this point in time? I should be waiting for a retest. Now the market is going back and is making a retest. What should I do? Immediately it goes back to the trend line, I sell, or I place my sell limit there. And then where is my stop loss going? My stop loss is going above this consolidation, which should be here. So let me calculate, or let me just use this. Let me use this as my entry, let's say at the retest, and then another as the stop loss. How many pips? Okay, let's add some buffer, add something. Okay, from these I can see that this is around, make it easier, from this is the entry and then this is the stop loss. So that is around 6 pips, stop loss. Imagine. And then what is the reward on this trade? Imagine. Can you imagine that? Around 94. It made a 94 pip sell off. And you had a 6 pip stop loss. Punch that on your calculator and know, okay, 94 divided by 6, that will be the risk to reward ratio. You can see that this is so massive. This is so profitable. You don't need hundreds of trade in a week to be a profitable trader. You don't need lots of trade to become profitable. No, you just need these kind of trades that you would hit it and move with decent profits. Nice risk to reward. Are you getting the flow? Okay, now remember I said your stop loss is going above the consolidation, while your entry is going once the market touches the trend line, you begin to fire your sell. You get? And then for take profit targets, this is where a lot of things get juicy. Yeah. So understand this. I first talked about stop loss. Reason is because in this trading we play defense more than offense. Yeah, try to protect your capital. The most. That's the most important thing about trading. Try to protect your capital. So where do you take profits? First of all, most conservative way is just the swing low. Take your profits there. But I wouldn't be taking profits here because the risk to reward is still small, around 1 to 2 risk to reward. So, but a lot of people can become they can be confident with that and just take it there, comfortable with that, take it there, and they move ahead. Second is, in fact, all these swings, first swing low, all these swings are your take profit targets. Oh, this is nasty. Let me use this. So this would be your next take profit target because of this swing low, and then this would be your next take profit target because of this swing low. You get? So these would be your take profit targets. But let me show you the best. Okay, I won't call it best because what is good to me might not be good to you, but this is what I do. I take the final take profit, the final take profit level. So that will be this third TP. That's what I'm going to take. And then having my entry here, and then my stop loss here, you can see the risk to reward ratio is nice. The risk to reward ratio is really, really, really nice. Now, moving further, I'm going to talk about risk management. Now, some people might not be having conviction behind just trading without seeing a candlestick patterns. Without seeing a candlestick pattern. Some people are like that. They just want to see candlestick confirmation. They want to add some confluence to their trade. I'll be showing you some confluence I use, but in this breakout strategy, I don't use candlestick patterns. So let me first show you another way of entering the market. Now you can see that once the market made this retest, it now formed a bearish pin bar. Although you might call this is a white candle, in this case it's bullish, but you can see that the rejection above is nice, showing us that we can call this a bullish candlestick. Now it is a bearish pin bar because it has more rejection that is bigger than the white part of the candle. So it is a bearish candlestick. And then they'll now place their entries. Okay, immediately it closed. That means here they will be entering here, and then their stop loss right above the candlestick, or adding some buffer just around here. So their entries here regarding this candlestick rejection, and then their stop loss here, and then their take profit here. It's still a nice one. But me, I don't, because at times it might just make a kind of retest and then make a big spike, and then you've missed the move. That's the downside about it, and I don't want that to happen to me. That's why I'm incorporating the idea of using it without candlesticks. Moving further, let me talk a little bit about risk management. Now, when managing your risk, you should be careful about the strategy, because you might be wanting to catch the whole move, and then the market will do like this. Pew. Okay, let me zoom in a bit and then delete this. Okay, let me delete all this first. So now you might be wanting to sell and then put your take profit at the last point, but the market will now take the second take profit level. Most of the times the second it normally does, move higher, kick you out, and then move in the anticipated direction to the final take profit level. So what do you do at this juncture? First of all, now once the market has moved in your favor, maybe it has given you 3%, 4%, just look for something that will be nice to you, or even 2%. Close out what you've risked on this trade. Let's say you are short and you are risking $100, and then the market has moved and given you a $300 profit. That means you should be closing out a lot size equivalent to $100, because $100 is your risk. So with this, you have even if it goes against you, you have nothing to lose. You've already made back that. So you can now look for the second entry here to make the profit. Or you can just close out 50% of your trades. Let's say for instance it has given you your $100 risk has given you $300. You can close out $150. It depending on you, any amount you want to close, just a fixed. I'll advise you use a fixed percentage. Okay, on this trade, I'm going to make it pre-planned, not when it's now happening. Your jitters are high and then you don't know what to do. You just close partial, take partials. No, that's unprofessional. Pre-plan your trade. That is, proper preparation produces nice performances, but poor preparation produces poor performances. So these happen in trading. You don't just start taking partial profit at any random place. It's looking so unprofessional. So tell yourself, okay, based on this trade, I'm going to be taking out 30%. I'm going to be taking out 50% once I get to 3R. You get? That's the right way to do it, and that's how I do mine. And then your risk management, I've talked about. Sorry for that. I've I've talked about how to do it, because at times the market can just make a second retest, and that second retest might kick you out. You can, and then at times the market might just move. It might not reach your final take profit level. It might just come to this place and then start going back. How do you do that? Once the market gives you a swing, you adjust your stop loss. Initially your stop loss was here, but once it has given you the swing, or delete this, okay, once it gave us this swing, you adjust your stop loss to somewhere around here, and once it gave you the second swing, you adjust your stop loss to somewhere around here till it finally smashes your take profit. The more it keeps giving you swing, let's say initially your stop loss was here, and then it moved and made this. Once it breaks out from this low, you shift your stop loss here, and once it moves and closes below this low, you shift your stop loss here. That is how you keep shifting, you keep trailing. You understand it? This is simple KHRH that I've taught in previous videos. KHRH means keep half and ride half. You're looking to ride it to give you more profit. You get? So the thing is, try to make your profits big when they come. Even if your losses are, let's say, out of 10 trades, you won only 2. But those 2 trades are giving you 10% each. And then the other 8 trades that were losers, you only lost 1% on each of them. So what you're losing, you lost 8%, but you gained 20% from the 2 trades. So what's your net profit? You have a net profit of 12%. You see, you are still profitable, although you have a very, very low win rate. 20% win rate, you are still profitable. You get? So it's not the number of trades that, the percentage profit that comes whenever you win is what matters most. So get that right from me today. This is all about trade management and risk management. Now, there are some chart patterns that work with this breakout strategy. For instance, we have the symmetrical triangle. Let's say you have price trading within a range and it's kind of forming a triangle. Oh, I missed this the way I was supposed to draw it, but just understand. For instance, it's straight. Oh, delete all this. I have this. The market is trading within this kind of chart pattern. This is called a symmetrical triangle within a chart pattern, and then it breaks out. You can look to employ this strategy there. And then you have head and shoulders pattern. Now, most of the time, let me give you this killer secret. Most of the time, when we have horizontal key levels like support and resistance, the market tries to it to me, it doesn't obey this breakout strategy. It usually fucks up. So what I normally do, I only look for where trend line is to be employed. That's where I use it. So if I have a head and shoulders pattern that, head and shoulders pattern might be like this. It might be like this. Then breakout. These are the shoulders, and this is the head. And head and shoulders pattern can also respect a trend line like this. Once I have a head and shoulders pattern like this that is respecting trend line, I want to see it make a previous touch. So I should have 3 touches on the trend line. 2 touches won't work, because 2 touches, someone can just pick 2 random points and wait for breakout there, and then you suffer false breakouts all the time, and then you blow your account. So be wise and look for 3 touches before considering the breakout. And then when it breaks out, one thing is, don't force your trend lines. Don't force it. The touch has to be neat. There shouldn't be too much wicks protruding from the trend line. Reason is because if you have too much wicks protruding from the trend lines, you will suffer false breakouts. You will suffer a lot of false breakouts. Try to make them align to the best perfection. Trend lines can poke out. Wicks can poke out, but it shouldn't be too much. It shouldn't be what? Too much. Once you look at it and you see, no, this is longer than, you use a little bit of common sense to tell yourself that yes, this is good and this is not good. Okay, so talking about the head and shoulders, now when it breaks out and makes a retest, you should start looking to sell. And then where should be your stop loss level? Your stop loss will go above the shoulder. Better still, if it makes a consolidation before, erase this. If it makes a consolidation before breaking out, let's say it makes this consolidation, it's a smaller consolidation that is lower than the right shoulder before breaking out, your stop loss can go above that consolidation. You can just add maybe a few pips plus the spread, and then sell once the retest is coming, and then you can look to catch the move. Your take profit targets, remember measured move. You measure from here now to here is how many pips. So that should be your take profit target. If this gives you 100 pips, you should target 100 pip, a 100 pip move. That is called measured move. So that is that about that. And then let me add other tips you need to know about this strategy. There are a lot of things. Number one I have here is never ignore confluence. In fact, beat your chest and say never ignore confluence. Now, when I was taking this trade, I wasn't just looking to take it based on trend line. I have a lot of reasons not to take this trade, but why did I now take it? Not a lot, sure. Because if I have a lot of don't mind my words. If I have a lot of reasons, I would avoid it. So I had reasons why I shouldn't take this trade. Reason is because I see something called imbalance here. This imbalance has to be mitigated. If you are a smart money person, you should know what imbalance is. But this is not for that. This is not for smart money concepts. Let me share with you reason why I took the trade, because it's not just based on that. I have a confluence. Looking at this, now I have 3 touches on this trend line. Let me make it touch perfectly on all sides. Okay, I have 3 touches. In case you can't see them, this is 1, this is 2, this is 2, and this is 3. I even have the 4th one here, So I have 4 touches on this trend line, the upward trend line, and this is giving me what? If I look at it, I see that this is not a trend channel. This is not a perfect trend channel, although you might call it's almost a trend channel. But looking at it, you can see that it is tapering, or it is going to, as if it's trying to join together to form what is called a wedge pattern. A wedge pattern is like this. It's going to meet at the end, and then that's ascending wedge, and then descending wedge is like this, going to meet, converge at the end, and then price is trading within it. Sorry for the rough diagram. Price is trading within it. That is wedge pattern. So when it breaks, it normally breaks out to the opposite direction like this. So it normally breaks out, retest, and move in the opposite direction to which it was moving. So that's it about that. Whether I call it a channel, whether I call it a wedge, all of them have the same thing in common, because I know that this is going to break to the downside. Even a channel, if I see a channel like this, I know it is trading to the downside. So what then is my second confluence? My second confluence is this. Let me go to, this is 15-minute time frame. Let me go to the 1 hour time frame. Forget all of the diagrams. Let me just delete all these diagrams. Delete all of them. Okay, so let me have a clearer chart. If I have this, I also have a trend line here. Sorry, let it load. My god. So Looking at it, let me just zoom it and do it from the 15-minute time frame. I can see that it has a trend line. It also has a trend line. Now, with this trend line, the market has reached the third touch of the trend line. Here, it has reached the third touch of the trend line. You can see the first touch, you can see the second touch, and then sellers are looking to sell here. But if I'm to go to higher time frame and sell it, my entry might be around here waiting for candlestick closure with my stop loss a little bit above that. And having this, I'll have a small risk to reward ratio, a very small risk to reward ratio. So how do I attack that? I come to this 15-minute time frame which we are on right now, and then I have this trend line. I have this trend line drawn and wait for a break and retest. That is what I waited for, and then took the sell. Can you see that? I have a confluence of downward trend line which the market has just touched. I have second confluence of this is not just a trend line being broken. This is a wedge pattern. This is a wedge pattern showing that adding to the confluence that this is about to sell off. Looking at it from higher time frame, let's go to the 4-hour time frame. You can see that this market is in a long-term downtrend. So I have a lot of confluence to take a sell here. Can you see that? So I'm trading first of all in the direction of the long-term trend. Secondly, on a trend line being respected, a downward trend line being respected. And thirdly, a wedge chart pattern showing an ascending wedge chart pattern which indicates a sell-off. So three confluences are good for trading. Three confluences are good. Yeah. One thing I want to add again is, I've said it earlier but I'll say it again, avoid fake outs. Avoid fake outs. Oh, you might be asking, when did this guy say avoid fake outs? Fake outs is just short form of false breakout. False breakout. I love abbreviations. So false breakout is what I call fake out. So if you are looking to you're trying to force yourself into the market, you might suffer fake out. Draw your trend lines neatly. Draw them neatly. You can see how I drew my trend line here. You can see the touches. Of course, the wicks protruded, but not too much. Not too much. This is fair enough to take a trade. So that once you see a candlestick close below it, you can start waiting for a retest. But if you just force your trend lines anywhere and you see a candlestick close below it, and then you watch the market move back and you start selling, you might eventually see that is just another touch of the trend line. So you are selling when the market is still respecting the trend line, and then you'll be in loss. But once you draw your trend lines very well and look for more confluence, that you are in the right side of the trade, you are good to go. You have a higher strike rate, and then a higher strike rate coupled with a big risk to reward. Oh my god, that's profitable trading, just with the right psychology. You get? So never ignore confluence, avoid fake outs, and do well to cut your losers. What do I mean cut your losers? Always set a stop loss. Don't be like, okay, just sell. No, cut your losers. Set your stop loss and calculate your risk on this trade. Calculate your risk on a trade. Because of this, I'm going to put a link of position size calculator. It's very easy to use. It's user friendly. Position size calculator that I use. Position size calculator of baby peeps. Or you can just go to Google and type position size calculator. There are a lot of free position size calculators, nice ones that you can use free of charge. You don't need to pay anything. You don't need to download anything. Just input your data there, your account balance, your stop loss, how many pips you're risking on the trade, and then the results will come out immediately. It's not so difficult. Okay, so and then let your winners run. That's the last point I have here. That's the last safe tip I have here. Cut your losers and let your winners run. I can't remember where I got this statement from, but I remember one book I read some months ago where someone said, cut your losers and let your winners run. Okay, that's it. What do you mean let your winners run? You see the market moving in your favor, and there is no valid reason to close out the trade. Why do you close it out? You don't close it out. Let it to move to more profit. And then you see the market just moving, and you're saying, oh, take partial profit, take 50% off, take 75% off. Why are you doing that when there is no valid reason to do that? You get? So be patient. If price gets to a support level, and then let's say for instance, like, you want to hold this trade longer, and price has come here to this, oh, sorry for that rough drawing, but understand that's just the support level I'm talking about, and price has come here, and then you say, okay, it's time to take 75% off. That is reasonable. Than the market is just at this point, and you're taking 75% off. Why are you taking 75% off? Is there any support level at that place? Is there any support level here to say, okay, start taking profit? No, there is no support level. There is no reasonable thing that will start pushing the market against you. So don't forget your top-down analysis like I just did. Go to the higher time frame, look at the support and resistance level, because at times you might be seeing a breakout, a potential breakout, and then that's just a fake out because market has just moved into the support level of a 4-hour time frame, a 4-hour support, and then it's trading within the trend line to the upside, and then you now see something like this. Then you see something like this, and you're feeling, oh my god, this is a good breakout, and then you place your sell limit, and then the thing moves in your favor, only to see that, oh, this is how the trend line was supposed to be drawn. So always look at the higher time frame, trade in the direction of the long-term trend. It will help you a lot. It will scale up your trading account. So thank you very much for coming by. Thank you very much. I believe you've learned something from here, and try to do more backtesting. Check it out on real life charts. You can choose to demo trade it before you go into live account to see what actually works for you, whether you should look for candlestick confirmations or not. All these things are so helpful. Just check them out and master them before you can risk your hard-earned money. You get my point? Don't just, okay, he has stopped this, I should start trading immediately. Master it first before you start trading it. You get? So thank you very much, and goodbye. I'll talk to you soon.